we're going to be covering the greatest trading blowups of all time. I had a lot of fun doing the research on this. Found three that we can dive into, and I hope we can all find something that is relatable. I think what's a little bit scary with this is as I've done the research, finding these guys who blew up accounts, who ruined retirements, who destroyed a corporation, there's something a little bit eerily similar to how we trade here at Castle University. And so this has been a really good lesson for me that we can avoid these and never have an account blow up to this magnitude. Let's dive in. Number one, off the bat, it just happened December of 2025. I want to introduce you guys to him. His name is David Chau. This is a real life picture of him, but this is David Chau. This is who we're going to talk about first. David Chau is also known as Captain Condor. If you search for Captain Condor or David Chau, you'll find him on Reddit. You'll find him in many, he's even on X. And he was the founder of a Discord community called Inside Options. It's $5,000 a year for his subscription. And what he does is he shows you how to sell non-directional S&P 500 iron condors on the SPX, on the index. When I learned this, I was a little scared because that's actually what I do that once in a while too. If you're a CFU member, you know that I sometimes will jump in and throw a condor on SPX and try and get $100 or $75 today out of it just to kind of pad the wallet and go from there. I don't get too hardcore into it. I don't, is there a way for me to get some money? But this guy, he founded an entire strategy around this one index, one ETF, if you will. Like he's just doing like SPY, SPX, that's it. And just know one strategy and milk it for everything he can. And he's a 32-year-old now, 32-year-old college dropout who turned into this options influencer. And what he would do, he would throw these iron condors over the S&P 500 for the day, hoping that it would be able to go sideways, doesn't go up, doesn't go down, and he would milk the premium and pocket that as income. And if he was wrong, say the late day or something, the S&P 500 would go up or it would go down, and therefore challenge his iron condor, he would roll it. And like I roll, like he's a rollaholic as well too. So we've identified another rollaholic. That's great. But he would double down all the time, which can be a little difficult with iron condors sometimes because you have to be able to get half of the premium. If, for example, you dive in on a 5 wide spread, the wings are 5 points wide, it gets difficult to get 2.5 out of that. So in order to get 2.5, you have to go really tight and it gets riskier the tighter you get. So his wipeout that ruined his account and the accounts of those who followed him was that he had a really horrible week leading up to Christmas of last year. That's how recent this one is. So think Christmas, December 24th, 2025. That is when David Chau, Captain Condor, entered into the trade that made him now infamous. Leading up to December 24th, he had two bad losing days in a row, which is statistically, I guess, rare, but it's going to happen every once in a while that you do have 2 bad days in a row, even 3 bad days in a row. But leading into December 24th, that was a half day of trading, right? Like the hours are only half day. And he had to do 90,000 contracts. So leading into this, he's putting down, I think he had to secure $31 million in order to try and generate $13 million worth of premium. He had to have the spread of the iron condor were 30 points wide. It was extremely thin. I know on the slide here it says 40 points, but it was actually 30 points wide that he was on this condor. So he's putting in a very large bet. This bet was so large, and it's on Christmas Eve. So there's no volume. Like everyone's gone home and they're celebrating Christmas with their families. Nobody's really actively trading the S&P 500 that day. So he walks in with this 90,000 contract bet, and the market maker had to move the market in order to accommodate this trade. And so this essentially comes down to being $50 million between him and the market maker and how they're trying to size this and allocate it appropriately. And wouldn't you know, in order for the market maker to do that, the market maker moved the market and then it went up and broke through his call wing. So this is the S&P 500 on Christmas Eve, 69.25. That was his short call, and he had the long call, or to help him out, sorry, it was 69.25 was his hedged call, and his short call was 69.20. It blew right through that. Into the closing hours of Christmas Eve, the market surged. It went right through 69.20. It went right through 69.25. He got a full call against him, and he wiped out $31 million. A total wipeout for the 3 days of this week was $50 million. It wiped out his account. It wiped out the accounts of many of those who are following him. A bet that was doomed to fail eventually. So that one is really cool. I thought that was really neat. Man, like 90,000 contracts. I couldn't even put down that order. Like I obviously don't have the money to support that, but 90,000 contracts, like your broker's not even going to let you do that. They have some sort of limits at 200 contracts, then 1,000 contracts. And if you want to go over that, you have to have like a brokerage account that is for market makers and like hedge funds, et cetera. So congrats on him for being able to put down 90,000 contracts to begin with. But dude, eventually it was going to fail. The Martingale betting system is eventually going to doom and bring you down. And just be careful if this is anything like the kind of trading that you do. When I read this, I was like, dang, that is kind of similar to some of the trades that I do. CFU members will know that I do like to roll, and I don't hesitate to widen the handles or widen the strikes and increase margin when we do a roll. I am aware of this betting system, and I know that it eventually will fail, and you will come into a scenario where you have 5, 6, 7, 9 losing events in a row. And so knowing that, you just have to know that there's a margin risk that you have to stop at. And it's an important lesson for everyone to know. If you do roll like myself, you need to know that there is a limit and how much risk you can accommodate. And at that certain point, you have to start to incorporate time risk. So you don't take on more monetary risk, you take on additional time risk. And that can soften the blow and make sure that you have time for the repair trade to occur, but then also you're not going to blow up your account financially. And that oftentimes in that time period, like say that time period is going to be 3 months or 6 months, like that's enough time for the trade to repair itself and come back into profit there. So let's go on to the next one. This is a new one. I had never heard of this company before. This is Aracruz Celulose. They are down in Brazil. They do bleached eucalyptus pulp. And if you're going to ask me what the hell is eucalyptus pulp, I do not know. Now, what do you need pulp for? I have no freaking idea. Maybe it's for straws. Maybe it's for making some paper. But this company is the number one leader of making this thing that we do not know anything about. Isn't that amazing? So eucalyptus pulp. I'm sure it's fantastic. I'm sure if you used it, you would think this is the best thing since sliced bread. These guys are in Brazil, and that's important because they are selling the eucalyptus pulp in USD, and they are paying their employees and operating costs in the Brazilian real. So, what these guys did is because they are an international company and they pay in local currency, they realized that what they needed to do. So, if any time the Brazilian real would appreciate or depreciate, or the US dollar would likewise go up or down, it could have a material impact on their ability to operate and obviously, therefore, make a revenue and generate profit for their shareholders. Like most companies do that operate in such a similar scenario, is you start to hedge currency. Now, in order to hedge currency, yes, you do have to pay a premium. You pay it to the market, and therefore you are hedged. So, what trade they were doing, if you're a Forex trader or you have some experience trading Forex, they were trading the USD over BRL pairing trade. Okay, so this is the Brazilian real versus US dollar. So what they would be doing is they're buying puts against the Brazilian real. So what they want to make sure is if the Brazilian real depreciates in value, that they're going to have the ability to sell a Brazilian real and then also be able to buy the US dollar. Yeah, that's how it went. Okay, because US dollars come in and then they need to be able to pay off in Brazilian real. So they would buy puts. That would be their hedging premium that they pay, and that would go to whoever the market maker is. They found out very soon is that this is very effective. They were able to hedge and make sure that they were able to continue to operate as a company. However, what happened is they started to say, hey, what if we start selling call options against the US dollar? And then that could fund how we pay for our puts. So if you want to buy a protective put, one of the best ways to fund that protective put is by selling a call option that's out of the money that can help you pay for the entire put or at least offset the cost. So that's what they started to do is they started to sell call options against the US dollar and then they would buy puts against the Brazilian real. What they soon found out is they could sell a lot of call options against the US dollar and then they only had to fund the near term Brazilian real. So what they started to do is they started to go far out in time and sell really far dated call options against the US dollar. In fact, when they imploded, they had sold 39 months out into the future. 39 months of call options against the US dollar. And then they were taking all of those proceeds and then they were just buying a little bit of puts against the Brazilian real for them to operate. And then the rest they were pocketing as profit. Well, in 2008, the Brazilian real collapsed in a very short order. And what happened is the US dollar skyrocketed in value versus the Brazilian real. As an American, you're like, well, the 2008 financial crisis devastated many things, but when you think about foreign currency, you don't really think about like what the devastating impact that had on other countries. Well, in Brazil, the Brazilian real was nobody wanted it. Everyone wanted US dollars because it was seen as a safe haven, or they had to also pay their debts and clear the book of a loan in US dollars. The Brazilian real collapsed. It went down 26% in like a week or two. And this trade, because the US dollar went so high up in value relative to the Brazilian real, all those call options that were far dated into the future were called on and they wanted their US dollars. And this company could not find enough Brazilian reals in order to pay for that US dollar because this was the pair trade that they were in. The trap that they got into is they saw how this was actually very usable, that they could use this to offset operating costs and be able to operate their company. But then they got greedy and then they got really greedy. And then whenever they would talk about what they were doing and how they were operating, they would always say, oh, this is within our conservative, normal functioning operating business parameters that we have to do to make sure that we have our currency hedged. But what they weren't telling regulators, what they weren't telling shareholders is that they were actually trying to pad this and make sure that they were making profit. This was devastating because this was emphasized by the short term focus that companies have on, hey, what are you going to do in the next quarter? Nobody was asking this company, what are you going to do 3 years from now? What are you gonna do with those call options that you've sold 3 years out into the future? And that's just not our nature. We don't ask that. We don't ask MicroStrategy, how are you gonna handle these convertible bonds that you have going on? But anyways, that's what happened with these guys. They went into receivership, all the executives lost their jobs, and then a competing company was able to do a hostile takeover, take them out, and to this day, I think they still operate, but they're under a different company. In a sense, the company's gone. Yeah, so this is the damage. So when their losses were called in, it was worth $2.1 billion. And that was the same as 3.7 times their entire 2007 earnings. So they had sold so far out and so much risk that their holdings of just Forex, like their Forex trader, had 3.7 times their entire earnings for the previous year. Dude, that is way too much. I get it. You're trying to hedge your currency. I get it. You're trying to make a little bit of money on the side to help the company out, but not 3.7 times into the future, man. That is way too far. Like, we always talk about like a 6 months emergency fund. Maybe that was far enough. You can just keep on rolling the hedge and rolling the call options. Because at worst case scenario, 6 months out or 3 months out, yeah, you would have had to book a loss. Okay, but it would not have taken down your company to this magnitude. They slashed their bond rating went to junk, and the CFO is sued by shareholders representing 97% of the voting capital. That's insane, right? So like people were pissed and went after this guy, sued him and all that kind of stuff. Yeah. All right. The next one. This is another one that kind of hits close to home. Like this one here with like cellulose and stuff. I don't know what a eucalyptus pulp is, but and like $2 billion, like I can't even fathom what that's like. But this one actually does hit home on a number of different levels. So first off, this is James Cordier. He had a company called OptionSellers.com. He wrote a book about how to sell options and make an income by selling naked calls and naked puts. Like, okay, cool. I don't care what it is you're going to trade on this. And he actually chose to do it on commodities. But naked calls are out of the gate the most risky option trading strategy you can get involved with. So if you think a covered call is risky, it's not. It's just your downside risk. A cash secured put, it's risky. It's up there with a naked call, but a cash secured put or a naked put, your maximum that you could lose would be the price of the security that you're selling your cash against, right? Your cash secured put. I guess the strike has to be taken into account too. So take your strike minus your cash. That's the most you could lose. But with a naked call, there's no limit. You could lose into infinity if there's a massive short squeeze like we saw like on silver, it's like you're selling the 27 or the 30 call option against silver. Guess what? That thing's going up to $120. That's going to hurt having to buy at 127, $130 and then selling that at 25 or $27 against the call option that you sold. So that sucks. Yes, call options, naked call options are the most risky option trade you can get involved in. After that, every option trade usually has a defined risk included with that. You're hedging in some form or fashion. This guy, James Cordier, he advocated of selling call options and selling puts to go with it. So what he ended up doing is he created this company and he would have tell people that I'm the master. I know how to do selling call options. Nobody does it better than me. I've taken this risky strategy of selling calls, selling puts, and I've made it into a conservative strategy for you. You can give me your retirement money, your savings money, all this, and I will make you money like you've never seen before. And it'll be conservative and it'll be something very safe that you can rely on. Well, you can imagine what's gonna happen here, right? So he starts selling naked calls against natural gas, and then he also sold naked puts against crude oil. And it's only a matter of time until one of these goes against you. In November 2018, there was a short squeeze against natural gas, and the price of natural gas skyrocketed. It went right through the roof, and this guy got 100% loss. Not only 100%, actually, it's more than 100%. So the clients lost 100% of their invested capital. And this happened in 1 month. They already didn't have enough capital to secure this. So with a naked call, it went so far into the money against this guy that it went beyond the normal margin that they would require you to hold in security. And it went beyond that. So not only did you lose your retirement money, okay, so you're no longer retired, you now owe money on top of that. So this clearing company, ITL FC Stone, had to clear and settle this obligation. So they did it. They settled and cleared the obligation, but then they had to go after this James Cordier guy and all of their subsequent investors below him and say, hey, like, not only do you owe us that, let's say you put in 150K with this guy. Not only do you owe us the 150K, which you've already taken, and we've taken that, you owe us another 30 grand. You owe us another 50 grand. So clients lost 100%. They also had to take out a second mortgage against their house to settle up and clear the bank with this one. This is disastrous. When you talk about blowing up an account, this is like blow up, you got no money, and then blow up like the structure that was even holding the money within it. Like you got nothing after this. You're left with like you might have to lose a kidney on this one. They're coming after you. This is James Cordier. So this is hilarious. This is his apology video that he put together. He's all alone in a boardroom, clean cut suit. He's got a Rolex on, and he's saying that he's very sorry and he's apologetic to his investors. And he says during the apology video, I'm disappointed because I won't be able to meet up with my wife down in Florence, like southern France or something, because of all this mayhem and chaos that I've caused. It's like, dude, yeah, I'm sorry you're not able to meet up with your wife in southern France. That's kind of a bad weekend for you. I apologize for that. Too bad you won't be able to go to France this weekend. I'll let you know how the sale of my house goes. And then we can go have some beers over at a pub or something like that. But this is the guy, James Cordier. He's the guy who effed up everything for OptionSellers.com. Okay, so let's break this all down. So we've got our three catastrophes. We got Captain Condor, we got James Cordier, and we got Aracruz Cellulose. What's the commonality across this? Well, there's actually quite a lot. So They overestimated their capabilities. Captain Condor said, I've found his amazing trading strategy. Nothing can ever go wrong. It's kind of the same thing with James Cordier. He was thinking nothing can ever go wrong. And oh, look at that. Aracruz Cellulose also thought nothing could go wrong. Hence why they were selling 39 months into the future against their US dollar. Another thing too is they ignored tail risk. So I think I have one here. We need to be talking about gamma risk. In all three of these strategies, they ignored tail risk and gamma risk that they had. So gamma risk is the sudden sharp change that can happen to a particular position. So gamma, as you look at your option chain, it'll tell you how quickly delta could accelerate against you. And it's important to take into account. Just know that on like a 0-day options, on expiry day, on things that have to happen today, your gamma risk is through the roof. Okay. That's your most gamma risk event you're going to have. And if that tail risk event just happens to occur that day, you just need to be aware that that's probably the black swan you're trying to avoid. And very quickly, that position could go against you, and you could be looking at a sudden complete loss. So just know that on expiry day, you want to get out of your positions. And so that's why at CFU, we suggest that you get out of your positions once they have hit 80% of your target profit. Okay. So when we do a vertical spread, when you do an iron condor, we like to target 80% as your final book your profit and go on. So if you have an iron condor and you sell it for $1, like 1.00, put in a debit order to close that iron condor at 0.20. Okay. That'll help you avoid pin risk and it'll also help you avoid gamma risk. Okay. This will also help you move on. Like once you've got 80% of your profit, it's efficient to move that capital into a new trade to keep on moving and keep on making more income. Those last 2 weeks or that last 5 days in order to get that dime or that 15 cents on the call option, it's not worth it. The gamma risk gets too high. Okay, so because you're just waiting for some tail risk event to occur. And right now, with the way the world is with Iran, and all these strikes. We're pulling in different countries seemingly every day with the new strikes. If NATO's going to be jumping in. You don't want to be carrying a lot of gamma risk and tail risk because something's going to happen. Okay, and then pride. So don't get into this like this idea that you're something special, that you can avoid some of these risks, that you have found some way to be better than everybody else. It's not like the market doesn't care who you are. It doesn't know who you are, and it's always going to operate the way that it does. It'll take you out if it needs to, and it'll reward you if it needs to as well too. There was a rumor actually going back to that David Chau with Captain Condor up here. This dude here, sorry, yeah, this dude here. So he actually believed that the market makers were working against him because on that day on December 24th, he believed that they saw his trade come in at 90,000 contracts. How could they not? They actually they're like, what the hell? Who submitted this order? Is this a joke? And they actually had to move and adjust themselves in order to accommodate his order. He thought that they were working against him. And there was actually a bit of an investigation done on this. And it was very easy to show from a market maker standpoint that no, they weren't hunting him. They weren't looking to take him out. In order to accommodate his trade, they did have to move the market just to make room for him. And then it was too bad that it went against him and it completely went out because the market maker is in the job of, yes, accommodating your order, but they also have a book and they need to make sure that it's not getting blown out the water as well too. So they're in the job of making sure they're fully hedged. And sometimes in order to fully hedge themselves, that you have to make the market move a little bit. Well, when he came in on December 24th, all on his own with 90,000 contracts, yeah, it looked like the market maker was against him, and I guess in a sense they were. They had to, offset that, but it wasn't true. They were able to prove out that they weren't doing anything nefarious, and this dude got wiped out. Sorry, David. You had $30 million. How'd you get $30 million and you're 32 years old, bro? Take that and go. So last one here. So yeah, I don't actually want to talk about this one. This is a kind of a silly slide about compliance and risk committees and clearing firms. Gross. So the trade away. So yeah, respect your gamma risk. We talked about that. Cap your tail. We talked about that. And hedge. Don't speculate. Try avoid any weird betting systems that you may have learned while you were gambling or with poker or with whatever thing you were doing like 5 years ago, 7 years ago, 2 years ago, sports betting or whatever those things are. They may or they likely don't apply to investing in the stock market or trading options. And there will likely come a circumstance in the future where that betting strategy will break down and it won't work. Just you got to think if your betting strategy worked as well as you think it does, everyone would be doing it. And then there would be some arbitrage or other actor who would act against you and take you out. So just be humble to the point of, okay, you know what? I'm nothing special and the market is the market. And there's trillions of dollars at play. And I'm coming in with at most, you got $10 million, right? You likely don't even have that. You probably don't even have 100K. Just be humble and know where your place is within this investing scenario. We're going to wrap up the live stream here. But before we go, I just wanted to give you this is coming. So, this is CFU book. I shared this in our Discord earlier where we're developing a trade tracking tool and it's mobile first. I wanted this to be like super easy so you can just like do it on your phone, right? I wanted to make it super easy for you to track a trade. So on your phone, as few clicks as possible. You got a nice, easy plus button right here. I just highlight that. You click on that, you add your trade. It's got all the strategies. You enter in your legs, how much you pay for a debit or a credit, and then it takes it and it tracks it for you. You can see here I got my NVIDIA covered call, my micro strategy vertical put, and AMD vertical put there. It's got how many days out into the future, what my profit is right now. And that's legit. It's real time tracking. We don't have a 5 minute or a 15-minute delay. It's real time. You got your goal here. So you can set a goal for like a monthly goal or a weekly goal. And you can track towards, are you getting your monthly or your weekly income goal? You can change it anytime you want, how many trades you got open. And this is cool too. So this is my performance. I think this is for 1 week or 1 month. I forget. It doesn't really matter because they're kind of one and the same, hasn't been around that long. So this is tracking my real-time trades. So I'm doing 100% win rate this week, 27% return per trade, $5,000 realized income with 8 trades that I did. And so what's really cool, and I really like this, it compares you against CFU's performance for the exact same time frame. So this is probably monthly, yeah. Because 13 grand in a week, we do pull that off sometimes. But a win rate of 92%. So CFU did 9 and 10% return per trade. And then your total income that we were able to generate at CFU was 13,000. So of course, this is across all of our traders and stuff. I think that's awesome. And so you're able to see your performance versus CFU's performance. And one feature we should add in here is if you want to track a particular trader. So if you wanted to go against Kyle, or if you want to go against one of the systems that we run, we should be able to put that into. So I'll put that down as a new feature and stuff. But you got your homepage, your portfolio. And what's cool is this is free for any CFU members. Subscriber, this is coming to you free, and you'll always have full access to this. If you're not a CFU member, we do have a free tier. So you can come on, you can check it out. You can trade one-legged options. But if you want to get the full feature for like multi-leg and you just want to use the trade tracker, we'll have a subscription fee for that. But then if you do want to get the full features and all of our trade alerts, become a CFU member, this will be rolled into your membership. I'm trying my hardest to get this ready for March 16th when we have our competition and contest. If you haven't heard yet, where we're going to run from March 16th until May 22nd, we have 6 guys who are going to compete head to head and see who is the best trader of these 6 traders who are CFU members. And whoever wins, we're going to present them with, hey, do you want to become a pro trader for CFU? And they're going to get paid and they're going to become one of the team, and we're going to trade with them for at least 1 year and hopefully even longer if they continue to produce and make great trades. Okay, so if you're interested in learning more about CFU, head on over to joincfu.com. It's the easiest way to learn more about us and to sign up and to become a member of CFU. Our members make fantastic money week out, month in, month out. And if you sign up, we'll send you what our performance is. You can go on our website. You can check it out there too. But sign up if you want to start for free. We even let people come in for free and check it out, kick the tires, and see if it's something that you want to do. Go over to joincfu.com, go to the top, hit free starter kit, and you're on your way. It's totally free. You don't get all the features and stuff, and you don't get the best trade alerts, but you get some trade alerts, and you can kind of see how we operate and how we do business. We've been in business since 2022, and we've been around for 3.5 years, and we're not going anywhere. And I love these lessons that we learned here today, and I'm going to incorporate them and make sure that I continue to be a responsible trader and leader for CFU. Thank you for being with us today.